Imagine a crystal ball that can glimpse you the future. Now imagine that crystal ball rolls down a hill, hits some rocks, and splashes into a river. And then the crystal ball pops out of a waterfall and magically reappears at your feet. Now the crystal ball might still work, sure, but it may be dirty or it may be murky from the inside. That's not unlike what happened this year in the markets. Surging oil prices, wildfires, a China slowdown, economic storm clouds retreating and reappearing. These unforeseen events clouded Wall Street's and Bay Street's yearly forecast. And as a result, everything that professional investors expected at the beginning of the year, a recession, layoffs, it hasn't come to pass. Instead, the complete opposite thing has happened. The bad predictions began in January and have continued up until autumn, with stocks unexpectedly rising in recent weeks and inflation worries resurgent. So why have investors been so wrong? Some of their biggest missed predictions help answer that question. So let's talk about the first prediction. People are going to stop spending money and it's going to cause a recession in 2023. Let's see how that ended up. So if you raise interest rates a lot, as did the Federal Reserve back in 2022 to battle inflation, making it much more expensive to borrow money and simply to be alive, people will stop buying stuff and the economy will slide into a recession, right? That's what pro-investors assumed heading into 2023. Investors put the odds of a recession for Canada 60% and America 70% in 2023. And no wonder, guys. Mortgage rates were near 5%. Excess savings from COVID-19 were quickly being depleted. But what happened was Americans and Canadians kept spending money, a lot of it, on Taylor Swift tickets, on travel, on entertainment, on everything. They started spending more money. So obviously that prediction did not age well. Let's talk about the next one. Next prediction, there's going to be mass layoffs. So in January, if you remember, Wall Street was convinced that if consumers stop spending money, unemployment is going to skyrocket, which would further dampen the economic growth, creating a negative feedback loop of increasingly soft demand and pink slips. But partly, since spending stayed strong, the labor market boomed. The job market was so tight at one point that employers had to boost their pay to fill openings. Not to mention, real wages also rose. In fact, jobs were so plentiful that employers felt comfortable to actually demand higher pay, sparking a series of high-profile strikes across the United States, a sign in their own way of labor market strength. Next prediction of Wall Street, inflation would stay high. Adding to the economic tailwinds, inflation actually ended up going down faster than expected, sliding from a high of 8.1% in 2022 to 2.8% in June. Some economists argued that this is so-called immaculate disinflation stemmed not from rate hikes, but from an increase in the supply of goods. Either way, the BOC and the Fed shrugged their shoulders and basically said, okay, good job everyone, and then they paused their rate hike path. And then they said there wouldn't be a recession after all. So investors changed their forecast, predicting that the central banks would start cutting their interest rates, perhaps as early as December this year. Wrong again. Last month, inflation surprised everyone, coming in hotter than expected. So investors revised their forecast again, betting that the first rate cut would come into 2024, if it comes at all. Next prediction that ended up going wrong as well, stocks would tumble or go to the moon. This is what actually happened. All the good news we got this summer fueled an unexpected stock rally. The S&P 500 surged from 8.7% in June to July, while the TSX popped about 5%. Nvidia's shares soared 25% in a single day, but the stocks did not shoot to the moon as a lot of investors hoped. That's because if rates do in fact stay higher for longer, that will weigh on stocks, and that possibility has thrown cold water on the rally. The S&P and the TSX have slid by 5% over the last month, surprise after surprise. Though to be sure, drawdowns are so common, they probably should not surprise us at all. So why has Wall Street been so mistaken this whole time? One reason why pro-investors were wrong is because they're usually wrong. Analysts failed to predict the largest swings of S&P 500 in the last 15 years. Most specifically, though COVID upturned much of what investors thought was true about the economy, and their trusty models, they were not built for the weird new world that COVID created. Most economic models do not treat the economy as an evolving thing, undergoing constant change. The economists explained not long ago. They instead describe it in terms of its equilibrium, a stable state. And this economy is anything but stable. Implausibly, consumer demand is not something that you can easily predict, nor the slowdown of a global superpower, and nor the immaculate disinflation. And since there are still a lot of open questions about the future, will oil prices keep inflation stubbornly high? Will the VOC rate hikes in 2024? How will the labor market fare? The world might just have a few more surprises left for us. If you enjoyed this video and would like to support me for free,